For the past decade, global capital markets have operated under a singular assumption. Geopolitical friction exists, but it remains compartmentalized. Regional conflicts don't trigger systemic unwind. Trade routes might tighten. Currency volatility spikes. But the financial infrastructure that connects every major economy absorbs these shocks and returns to equilibrium. That assumption is being tested in ways markets are only now beginning to price. The scale of interconnection that has defined the post-2008 era is unprecedented. Over $300 trillion in notional derivatives link equity markets to commodity futures, to currency volatility, to sovereign debt spreads. A supply disruption in one region doesn't stay regional. A sanctions regime doesn't remain isolated to a single actor. The system is too dense, too dependent on continuous flow, too vulnerable to friction at critical nodes. This is not prediction, this is structure. For 30 years, the dominant financial paradigm rested on a specific foundation, the belief that economic interdependence was a guarantor of stability. If nations were deeply integrated through trade, investment, and currency flows, the theory went, the cost of conflict became prohibitive. Mutual destruction through economic severance was cheaper than actual conflict. This wasn't naive, it was rational within specific constraints. The post-Cold War period saw unprecedented capital mobility. Advanced economies industrialized emerging markets. Global supply chains became so efficient that companies could produce components across 4 continents and assemble them in a 5th. Multinational corporations became the primary architects of geopolitical behavior, not governments. Finance followed trade. Banking followed finance. Central banks, in turn, became the ultimate guarantors of system stability. By 2008, this integration had become so complete that the failure of a single investment bank threatened to collapse the entire system. The financial crisis revealed the dark side of interdependence. When trust breaks, density becomes fragility. But rather than unwind that density, policymakers did the opposite. Central banks flooded the system with liquidity. Quantitative easing wasn't just about rescuing banks. It was about preventing the revelation of how deeply fragmented incentives had become. Low rates didn't return to normal. They became permanent. Negative real rates became the baseline. The cost of geopolitical friction was absorbed by keeping nominal returns in risk assets perpetually higher than the cost of holding cash. For 13 years it worked. Equities climbed, real estate appreciated, volatility metrics compressed. The system rewarded those who stayed long. Geopolitical risk became a background noise, acknowledged in headlines but priced as a minor variance in tail risk models that assumed most shocks would be small and manageable. This pricing structure was never tested at scale. It was only assumed. To understand how markets actually respond to geopolitical shock, you need to see how the system processes information about instability. Markets don't move on geopolitical events themselves. They move on the perception of cascading consequences. A conflict in one region becomes a market event only when it threatens one of 3 critical flows: energy supply, rare earth supply chains, or the willingness of capital to move across borders. Take energy first. Roughly 90 million barrels of crude oil flow through global markets daily. The Strait of Hormuz alone accounts for approximately 21 million barrels per day, roughly 1/5 of global oil consumption. This choke point isn't a metaphor for fragility. It's the literal architecture of global energy distribution. If that strait closes for even 30 days, global oil inventories deplete at an accelerating rate. Prices don't merely spike, they dislocate from traditional supply-demand equilibrium into a state of pure shortage pricing. When shortage pricing activates, it creates cascading effects. Transportation costs rise immediately, manufacturing input costs rise within weeks, consumer prices for goods rise within 60-90 days, inflation expectations re-anchor upward. Central banks face the choice: accommodate the shock, allowing inflation to rise, or tighten policy, risking recession. This isn't theoretical, it's mechanical. But here's where the current system differs from the 1970s energy crises. Central banks are no longer independent institutions with the political capital to accept short-term pain for long-term stability. They are extensions of fiscal policy. They have explicitly adopted financial stability as a mandate. They have signaled repeatedly that they will not allow asset prices to fall significantly due to exogenous shocks. This creates a trap. If geopolitical shock drives energy prices higher, inflation expectations rise. Central banks signal they may hold rates steady or cut rates to stabilize assets. Markets begin pricing in persistent inflation with accommodative policy. Real yields turn deeply negative. Savers flee to hard assets. Gold demand spikes. Sovereign bonds sell off. Credit spreads widen. Now multiply this across multiple dimensions. Rare earth minerals are concentrated in 3 countries. Advanced semiconductors depend on a single geography for cutting-edge production. Agricultural production in 2 regions supplies roughly 30% of global grain exports. Fertilizer is sourced from conflict zones. The system doesn't have redundancy, it has efficiency. Efficiency and redundancy are opposites. The shift began in early 2022. not with a single event, but with the realization that previous assumptions about geopolitical constraints were being violated. For the prior decade, geopolitical risk premiums had been priced as roughly 1 to 3% on energy markets and minimal premiums elsewhere. The model assumed that conflict, when it occurred, would be contained. Sanctions, when imposed, would be partial. Supply chains, when disrupted, would reroute around the damage. All three assumptions were tested. All three were found wanting. The shock wasn't that conflict occurred. Regional conflicts happen frequently. The shock was that developed economies, for the first time since the Cold War, moved toward economic decoupling from major geopolitical actors. Sanctions became total. Supply chains began rerouting not temporarily but structurally. Long-term contracts were severed. Relationships built over decades were rewired in weeks. The market hadn't priced this. The pricing models assumed geopolitical risk was a volatility event, painful but contained, manageable within historical parameters. Instead, it became a structure risk. The underlying configuration of global trade, energy flows, and capital movement was being rewritten in real time by political actors, not market forces. This is a different animal. Volatility events mean prices move but return to trend. Structure risk means the trend itself is broken. The evidence appeared in multiple markets simultaneously. Energy markets saw the steepest backwardation in decades, a market structure that signals scarcity and fear of supply disruption. Prices for immediate delivery spiked while future prices lagged, indicating market participants believed shortages were real and near-term. This structure persisted for months, not weeks. Traditional supply responses didn't materialize because traditional supply sources were sanctioned or politically unavailable. Grain markets experienced the same pattern. Ukraine and Russia supplied roughly 30% of global wheat exports and a higher percentage of fertilizer. With those flows interrupted, prices spiked. But more importantly, countries began implementing export restrictions. India banned rice exports. Indonesia banned palm oil exports. This wasn't market function. This was governments breaking the assumptions that global trade would remain fluid. Financial markets lagged in pricing these realities. Equity indices continued to climb, even as underlying commodity prices, shipping costs, and credit spreads were signaling tightening conditions. The lag wasn't ignorance. It was the anchoring effect of central bank put options. Markets had learned through 2008-2021 that when stress appeared, central banks would suppress volatility. But the 2022 shock was different. Central banks faced a dilemma. Inflation was rising due to geopolitical supply shocks, not monetary excess. Raising rates would slow growth, but wouldn't cure the underlying supply problem. Holding rates steady or cutting would accelerate inflation. For the first time in a generation, central banks were forced to acknowledge that some problems they can't solve with liquidity. That acknowledgement changed pricing. Not immediately, not dramatically, but persistently. The escalation hasn't been linear. It's been characterized by reprieve followed by renewed stress, creating a pattern of rising volatility floors. In 2023, energy prices normalized. Geopolitical tensions seemed to stabilize. Markets priced in a return to the previous regime of contained risk. Equity indices climbed. Volatility metrics compressed again. The assumption that shocks would be temporary reasserted itself. But the structure underneath had changed. Energy independence became a stated policy objective across multiple developed economies. Reshoring of critical manufacturing began accelerating. Supply chain redundancy, which had been systematically eliminated in the name of efficiency, began being rebuilt at significant cost. These aren't one-time adjustments. They're ongoing capital expenditures that reduce profitability of the companies undertaking them. The second escalation came from capital flows. For decades, developed economies could run fiscal deficits because foreign central banks were willing to hold their debt. This was the core of the petrodollar system. Countries needed dollars to buy energy, so they accumulated dollar reserves. The U.S. Treasury market was the ultimate safe haven. That assumption is fraying. Geopolitical fragmentation means countries are less willing to hold reserves in the currency of a geopolitical adversary. China and Russia began systematically reducing dollar holdings. India, Saudi Arabia, and other emerging powers began diversifying away from dollar-centric reserves. This isn't a dramatic collapse in demand. It's a structural shift in the composition of who holds U.S. debt and at what yields they're willing to hold it. The signal appeared in Treasury yields. For the past 15 years, 10-year yields had remained range-bound between roughly 1% to 3%, even as fiscal deficits swelled. This was possible because demand was stable and reflexive. Pensions had to hold it. Foreign central banks had to hold it. The Fed could control the yield curve. In 2023-2024, that began to break. Yields drifted higher even as growth slowed, a pattern that historically precedes either inflation reacceleration or a loss of reserve currency confidence. The math is simple. If the U.S. Treasury market is less universally desired, yields must rise to attract marginal buyers. This isn't a temporary move. It's the logical outcome of geopolitical fragmentation. A third escalation is appearing in real time, the pricing of structural inflation. For a decade, central banks convinced markets that inflation was transitory, the result of temporary supply shocks that would resolve. Each time inflation proved persistent, the narrative shifted slightly. Longer transitory, then sticky, then higher for longer. Now markets are beginning to price a different possibility, that inflation is structural, not transitory. Geopolitical fragmentation means supply chains will be less efficient. Nearshoring means higher labor costs. Decoupling means duplication of capabilities. Energy transition means capital intensity. None of these are temporary. If inflation is structural, the yields required on bonds rise structurally. The valuations of growth stocks compress structurally. The real returns available to savers fall structurally. Asset prices that have been supported by the combination of low rates and low inflation expectations require significant repricing. The data is beginning to show this shift. Equity valuations remain elevated relative to historical averages, but the composition is changing. Defensive sectors are outperforming. Gold is appreciating not due to monetary weakness, but due to real yield compression. Volatility indices remain muted, but skew metrics, the price of tail risk, are rising. This is a market that is beginning to accept that downside risk is real. When geopolitical shock meets structural fragmentation, outcomes are rarely symmetrical. Some actors benefit immensely. Energy producers in geopolitically stable regions, Norway, Canada, Australia, see their commodity wealth revalued upward. Defense contractors experience secular growth tailwinds. Companies that successfully nearshore manufacturing capture efficiency gains. Precious metals benefit from both inflation fear and real yield compression. These aren't speculative benefits. They're structural outcomes of geopolitical reconfiguration, but most market participants are exposed on the other side. Manufacturing-heavy economies dependent on imported energy face margin compression. Companies with global supply chains face higher input costs and lower pricing power. Financial institutions with significant exposure to emerging market debt face currency volatility and default risk. Pension funds that have been forced into equity-heavy allocations due to low rates face the dual compression of rising real yields and falling growth expectations. Consumers in developed economies face a specific squeeze. Wages grow slower than inflation expectations, reducing real purchasing power. This creates political pressure on central banks to hold rates lower than would be warranted by inflation, which deepens the real yield compression and accelerates capital flows toward real assets. The most exposed are those who benefited most from the previous regime. Asset-heavy entities that leveraged low rates to achieve high returns, central banks that staked their credibility on perpetual rate suppression, and governments that treated fiscal space as unlimited because debt could be rolled perpetually at low rates. For central banks, the exposure is existential. If geopolitical shock triggers inflation, they face a choice between allowing real yields to rise, risking financial stability and asset price declines, or holding nominal rates low, allowing inflation expectations to de-anchor permanently. There is no path that returns to the previous regime of stable asset prices and contained inflation. For governments, the exposure is fiscal. The U.S. debt to GDP ratio stands at roughly 130%. If yields rise structurally due to geopolitical risk and capital flow reallocation, debt service costs rise dramatically. A 2% structural increase in 10-year yields, multiplied across $34 trillion in total public debt, represents hundreds of billions in additional annual interest payments. At some point, that math becomes mathematically unsustainable relative to tax revenue growth. For corporations, the exposure is margin compression. Energy costs rising, labor costs rising due to nearshoring, capital intensity rising due to redundant supply chains, and pricing power constrained by consumer reluctance to accept inflation, these move in the same direction simultaneously. The most important exposure, though, is behavioral. For 13 years, the market has learned that volatility is temporary and central banks are omniscient. Geopolitical shock is teaching it a different lesson. Volatility is structural, central banks are constrained, and outcomes are increasingly outside policy control. When a decade of learning is inverted in months, the repricing is often violent. We are not at the edge of crisis. We are not in a crash. We are in a regime shift where the assumptions that defined financial markets for a generation are being slowly, then suddenly, invalidated. Geopolitical fragmentation is not a temporary event. It's the logical outcome of political incentives in a multipolar world. Capital reallocation is not a one-time adjustment. It's the reflection of changed perceptions about which assets and which currencies carry geopolitical risk. Inflation is not transitory. It's structural to a world where efficiency is being sacrificed for resilience. These aren't predictions of catastrophe. They're descriptions of what happens when the variables that drove 20 years of financial returns reverse simultaneously. The market will adjust. It will find new equilibria. But that adjustment process is by definition a period of repricing, volatility, and winners and losers. The viewer's only question is, do you understand which regime you're in, and are your allocations consistent with that understanding? That judgment is yours.